Okay. Uh, Welcome in today's discussion. Today we want to send our discussion to financial accounting or accounting. I tend to believe all of us where we are doing well. Now, as I mentioned earlier, if you are new to the channel, we are here to simplify this accounting and units regards to mathematics. So hang on my lips as now we are today venturing in this financial accounting. Okay. Financial accounting, what I can say, financial accounting from that word, financial accounting. Financial accounting. What I can say, financial accounting comes from the two words. Financial accounting comes from two words of financial and accounting. Financial accounting and financial. Accounting and financial. Accounting and financial. Good. So accounting now comes from the word account. From the word account, to account. Here we are going to give a report. To account, we are going to give a report, or we are going to report on something. We are going to give a report, or we are going to account on something. And we are going to account on what? Financial. We are going to account on financial, which comes from the word finance. Meaning we are going to give a report on things that we can attach monetary value, or we can attach things to do with money in the business. Good. Now, as I've mentioned, now here you will realize that now we can say in simple words that financial accounting is to give a report or to report on something that is of monetary value, that you can attach monetary value. Good. That is just a short definition of financial accounting, but we are going to venture into it deeply. Good. You realize that accounting accounting has been considered as the language of business. Accounting has been considered as the language of business, and it has got various definitions. Which we'll have to look into it in detail. Good, we have to look into it in detail. But for this case, today, let me give you one definition for financial accounting. So definition, let me give you this definition for financial accounting. Especially for those who are doing financial accounting 1, you can say financial accounting is the act of recording business transaction. Is the act of recording business transaction. The act of recording business transaction and summarizing them. And summarizing them into financial statements, into financial statements for decision making by the users. Good. Is the act. Good. So I will point out key words from our definition. And one, we have been told, is an act. Then we have been told the act of recording. So we are going to do what? Recording Another term we can point out from that definition, recording. We are going to record what? Business transaction. We are going to record business transaction. We are going to record business transaction. Then we are going to summarize them. We are going to summarize them. Summarizing. We are going to summarize them into financial statements. Into financial statements. Into financial statements. Into financial statements. Into financial statements for the decision making by the users. For the decision making by the users. Good. So I will start to give a simple, maybe to a clear picture of these key terms from our definition. An act. Now, an act will come in. I will give an example like now. This is now an accountant will come in. Here we have said we are going to give a report, or we are going to report on something that has happened. And we have said we are only going to report on things that we can attach monetary value. We can attach things that are of monetary value. So that act of recording, that act of okay, that is going to take place in that business by an accountant, he will do the recording of things that he or she can attach monetary value. Let's say in a business thing, something happened, like in a case that maybe somebody get injured because of maybe one reason or another. Let me give an example. Maybe one person maybe get into fight with another, then one get injured. This, yes, it is something that has happened in the business, but you realize an accountant is not in position just to record it. That is of another level. Maybe for human resource manager, you can call them and maybe solve the dispute. But an accountant will only come in maybe when he or she is asked upon to give what? To give money so that they can cut off maybe for medical purposes, especially when there is somebody who has been taken to the hospital, maybe for medication. That is when an accountant will record down. We record down that I gave out maybe 1,000 shillings to cut off for one of the employees who got injured, maybe due to maybe the fight that took place in the business. So that is maybe we call now an act of now him or she recording down that money to account for it at the end of trading period when we are going to prepare what? Financial statements. Good. Then recording. Now recording comes in now. Things we have said monetary. No? Monetary. So he is going to record things that are only monetary. We are going to look into concepts of business concept in accounting, and we realize we are going to look into those things that are a principle that tells us that we have to deal only with things that have got of monetary value. None other than things that are not of monetary value, we are not going to account for them in accounting. We are not going to account for them. Good. Business transaction in this case, here I always say business transaction, we have two types of business transaction. We have cash transaction, and we have credit transaction. We have cash transaction and we have credit transaction. Cash transaction in this case is simple. Buying goods in maybe a business and paying for them on spot. When customers come to us and they buy goods and they pay on spot, either using cash in hand or they are going to use maybe check to pay us. That one we call it cash, maybe business transaction. Cash business transaction. Good. Maybe then we have credit transaction. Credit transaction, this is where now we'll buy goods and pay for them at a later date. Maybe suppliers sells, maybe they supply us goods and we pay them at a later date. We refer to them creditors because we are going to pay them at a later date. But when we pay them on spot, we refer to that type of business transaction as a cash transaction. But if we pay them at a later date, now we refer to that a credit transaction, which is a kind of business transaction that has taken place. Good. That are two types of business transaction. But here in cash, you have to know that you can either pay by cash in hand or you can either pay by check through the bank. So know that one. Good. In summarizing, now here, we have business transactions that are going to take place. We have said we have cash transaction that are cash transaction, and we have credit transaction. You realize we have those books that record cash transaction, like cash book. Cash book records cash transaction in the business. Anything that involves cash in the business, on cash transaction in the business, we record them on the cash book. But we have those that record credit transaction. That's where we are now going to come in with the things to do with journals. Journals, various types of journal. We have sales journal that record credit sales. We have purchases journal that record credit purchases. We have sales return journal. Those are kind of books which we are also going to look into them. We are going to liberally to venture into them and know how we can record these books. Now, after we have recorded these books, now you see, we now get from the source documents that in those various documents, like the cash book, you get the source document for the cash book is a receipt. Now that receipt, the accountant had to note down in the receipt that this amount costed these goods and recorded in the receipt. Now when we are now transferring them into books, we are now summarizing them in various books. Those for cash transaction, put them in the books of cash transaction. Those for the credit transaction, we will put them into the books of credit transaction. After we have done all those listing, we will summarize them together, then post them into ledgers. We are all going to see that. So under this summarizing, we are going to understand more when we are dealing with something called accounting books. Accounting books. Good. Financial statements. After we have done the recording, we have done the transaction, we have engaged in various business transactions throughout the year, throughout the trading period, we have to come up with a financial statement at the end of trading period. The end of the trading period can vary in businesses. Maybe a certain business can run a business for 1 month, other can run maybe for 1 year. So at that 1 year, we have to come up with the final accounts. We have to come up with the profit and loss account. We have to come up with the balance sheet. All those are financial statements. We have to know the financial position of the business at end of the trading period. So that's where we'll come up with the balance sheet. We'll have to come up with the profit and loss accounts. All that we are going to do what? To learn here in our studio. So just subscribe and you won't miss this. Now, so here we are coming up with the balance sheet, which I will show you how it is being prepared. I will show you how we prepare profit and loss account. Profit and loss account. We'll also learn to show you how we'll prepare financial position, in relation to balance sheet. We'll also have to come up with the final account for maybe for the sole traders and all that, even up to the company level and even the partnership. Good. Then we have things to do, users. We are going to venture into users. We have to know who are these users of financial accounting. They are those users who we are, everything we are doing here, we are going to, at the end of the day, this information we are going to prepare here, we are going to give to the users. We want to give users this information so they can use it in decision making. So they can use it in decision making. They can use it in decision making. So we ask ourselves now, who are these users of financial information that we have prepared here? Now, you realize I will come up with an acronym that is going to guide us on how we can remember when we are dealing with the users. Or in case you have been asking an exam scenario, or in any event when you are in a business or in an organization, when you are preparing the information, you know that this information you are preparing purposely to be used by somebody for decision making. One, so I will just note this one. We have the acronym here, which I have always coined so that it can help us in remembering this. We have an acronym called guest clip. Guest clip. Guest clip form. You can add form there so that you can have more points. Now, here we have one government. Here we have government. We are preparing this information, financial information for the government. Why? Purposely so that they can come and be able to tell that business can, the taxes you are going to pay. They can come in and tell that you are going to pay this amount of tax, because not all business we are going to pay the same tax. It will depend on the information you are prepared. So the information you are prepared, the government will look into it, that agency, then after that they will be able to tell you that here you are going to pay certain taxes in regards to what we have now reviewed in your information are provided to us. Good. Then we have employees. Employees. What is the purpose of employees or in need of the information? Employees here, they are of need of the for accounting information, so that they can know if this business is going to be there for them in future. Are you going to maybe to exist, or you can collapse anytime? So they are very in need. And also to maybe to use the information to argue on their maybe salaries. You know, they want to know, are you maybe paying them what is required of them? Maybe you are making mega profits, but the salary they are going with it home is not worthy in regards to what they are giving to the business. Good. We have people here, other people called suppliers. We have suppliers here now. Here I said employees. Then here we have suppliers. No, I don't think in a business we can survive without suppliers to come in. Suppliers in this case, they need this financial information, because at one point you'll engage in a business transaction that is called credit transaction. And in this time, you'll have to get into MOU or Memorandum of Understanding, whereby they have to supply for you goods, and these goods you have to pay at a later date. Now, the supplier will come to you and will get in need. Will want you to provide the accounting information. He want to see the financial position. He want to see how the business is doing. By that, the supplier will see, are you, the business you have, the goods you have asked him or her to supply for you, are you able to pay for them? No? If the business is making a certain profit, maybe a good profit, now the supplier will know that he will be assured that these goods I'm supplying is going to do what? At the end of that period we have agreed, my customer will pay for it. So the suppliers are also in need of accounting information. Suppliers are also in need of accounting information. They are in need of accounting information. Good. Then we have clients and consumers. Clients and consumers. Clients and consumers. Good. Here you realize that consumers now need accounting information in order to determine the continuity of the business. They want to see the continuity of the business. Are you going to be there? Most especially when there is maybe long-term engagement. Because you realize some of the clients or customers, they can come and maybe give in their money so that you can be providing for them at a certain period. You know, not only people come just buy and go. There are those who can come and get in agreement that let me pay this, but you'll provide for me this type of goods or you'll supply for me this organization or this firm, you're going to supply for me these goods at maybe a period of 1 year. What if this business collapses along the way? It means the client or the customers, they are going to suffer, or the consumers, they are going to suffer, because there will be no business that will be supplied to them. So they are in need of this accounting information so that they can do what? They can tell that you are going to survive in near future. Good. We have lenders. Lenders. They are also in need of accounting information. Who are lenders? In this case, I can just refer to banks. You know, banks, in this case, banks are here. Because banks, they need this accounting information. They have to tell, because one day you will walk in the bank and you are in need of a loan. This loan, giving to the business, they will have to review the accounting information. They have to tell, are you able to pay this amount of money or amount of loan you have borrowed? So the banks comes in there. We have now letter I. Now, investors. Investors. You know, investors in this case, investors need accounting information in order to make relevant decision. They have to make relevant decision. Through accounting information, they could maybe determine whether to purchase maybe the stock or maybe to venture into that business. They cannot invest in something that is not making profit. So the investors, they have to know, are you making good profit? But if the business is making good profit, now they are able to venture into that business. We have the public now. Good. We have the public here. So the public is just us, all of us, maybe generally the community where the business is taking place. They have to understand, are you going to exist? So that they know that if you are going to be there, you will be providing for them goods as they continue depending on you. Good. And how you are going to be benefit that community, because where the business actually taking place, maybe certain environment, automatically you will realize that there's going to be maybe there's going to be growth in that area, maybe through maybe schools that are going to develop there, hospitals, because people are going to be there. There's going to be increase of population. People are going to migrate to that area, and we realize things to do with the infrastructures, roads, they are going to be improved. Good. Then we have a financial analyst or advisors. Financial analysts or advisors. Here I can say maybe like auditors. They need information. We need this information so that we can give a valid maybe advice. We can tell you here, venture in this or don't venture in this, because this project has given you this. So if you provide us, we will tell you next project, if you're going to venture in this, they will advise that venture in this. So here you can say financial analyst. Financial analyst or advisors. Financial analyst or advisors. Financial analyst or advisors. Financial analyst or advisors. Good. Then we have owners. Owners of the business. Owners. Good. We have to know, are we making profit? Are we making loss? So with this kind of information that will be provided to us, we'll be able to tell if we are making profit or we are not making profit. So the owners are also in need of the information so that they can do what? They can be able to tell if they are doing good in the business or they can venture in another business. Then M will finish by managers. Managers in this case, they need accounting information so that they can see the plan that they have maybe designated to that business or to that activity, the business that they are in now. Is it yielding out the profit? If this plan that they had suggested for the business is not making progress or is not giving good result, they can change. So here will come in the plans, because the managers are the ones who are coming up with plans or giving advices to the investors or stakeholders, shareholders, that let us do this and let us do this. So at the end of the day, or at the end of the financial financial period or trading period, they are in need of this information so that they can tell, are they making a profit or the plan, is it working for them? So if not, the plan is not working for them, now they are going to do what? They are going to change the plan. So if you get this term or just this acronym, guest clip form, it will help you to remember the uses of financial information. And this question is very common, so just get this acronym and it will help you, and just give that symbol explanation on each user and you are good to go. Good. So you have seen, think we have digested well in that area. We have seen well in that area. We have seen up to users. Now, let us see now something to do with the objectives before we get into anything else. We have to know the objectives of us coming up or engaging in accounting. Objectives of accounting. As I said earlier, accounting is a business term. Accounting is a business term. And why are we engaging? The objectives. Objectives of business or objectives of accounting. Objectives of accounting. Objectives of accounting. Good. We have to know the objectives of accounting. Objectives of accounting. Good. Objectives of accounting. Objectives of accounting. Good. Objectives of accounting. Objectives of accounting. Good. Let us look into now the objectives of accounting. Good. One, I'll say systematic recording of transaction. Systematic recording of transaction. Systematic recording of transaction. Systematic recording. Systematic recording of transaction. Good. That is one objective why we are learning if this financial accounting. When we are there in the business, we are going to record our transaction systematically in the order of occurrence, how they have occurred. That's why we are going to look into the day books. We are going to look into the prime books, because we are going anything that happens on daily basis. That's why we are going to venture into journals, because we said in journals we record transaction in a chronological order. You know, that's why we are saying we are going to systematically record a business transaction. So one of the objective or basic objective of accounting is systematic recording of accounting, systematic recording of business transaction, either a credit transaction or a cash transaction. We are going to record it systematically. Good. Then two, we are going to ascertain. Ascertainment. We're going to ascertainment of above recorded business transaction. Ascertainment of recorded business transaction. Ascertainment of recorded business transaction is another objective. As an accountant, we have to prepare loss and profit. We have to know that the results of the business operations at a particular period of time. We have to tell at this particular period we have made this profit and this profit. So regarding on the what we have recorded, we will be able now ascertain it by coming up with maybe profit and loss account. So we are going to ascertain that. Then we have another one. So here is where now we'll see, we'll prepare what? Even we'll prepare balance sheet. We are going to prepare balance sheet in that case, so that we can know the financial position of the business. Financial position of the business. Then another objective is providing information to the users for relation of decision. Users, good. That is one of our objectives. We have already done that, and I've already given out the users of financial accounting information. So we are going to provide, another objective is to provide information to the users for their relevant decision making. Then to know the solvency position, to know the solvency position of the business. Here now, by preparing maybe the balance sheet and coming up management not only reveals what is owned or what is not owned by the business, but also it will give the information regarding the concern's ability to meet the liabilities. Ability to meet the liabilities maybe in the short run, you know, the short run, that is liquidity position, and also in the long run, the solvency position. So we are going to know, we have the liabilities. Are we in which position to settle these liabilities? Either we are going to settle them in the short run, or it will be a long-term settlement. Good. So that was just a few, but there are many. So by these four, the major ones, you can have them, so that when you are asked to give the objectives of accounting, you know, one, we are going to record systematic recording of business transactions. I think we know now business transactions, what are they? To ascertain of the recorded business transaction, you ascertain, wow, we are ascertaining by the profit and loss account, you ascertain by the balance sheet, so that you know the financial position. You're also coming up with the, so that you are preparing this financial accounting to give the users, and I've also give out the users with their various need of that information. We have also the solvency position, whereby we are going to see, are we going to settle, how we are going to settle our liabilities, maybe in a long run, that is liquidity position, or in a short run, or in a long run. Good. Now, we are just saying information. You know, this counting information is classified into three. Let us see now the definition. We have just been talking about accounting information. So there are three classifications of information of accounting, which we are going to venture in from time to time. Now we have three classifications of information. Here we have qualitative information, type of information of accounting that we'll be able to look in. So we have qualitative information. So three classification of accounting information. A classification of accounting information. Here we have one qualitative information. Qualitative information. Then we have two. We have quantitative information. Quantitative information. Then lastly, you can say financial information. Financial information. Good. So, quantitative information, this is information expressed maybe in numbers, quantities, or units. Numbers, quantities, or units. Here, we'll be talking about numbers. You know, in accounting, it's not only just about to crunch the numbers here, you know, as I've said, but we are going to look deeply. We are going to justify, you know. Good. So numbers, units, kgs. You'll be talking about the maybe 10,000 Kenyan shillings, all that in numbers. Then we have qualitative. This is expressed in words. Here we also information in regards to accounting, but it will be in words. In words. Then here actually is just information expressed in terms of money. Here the information is expressed in terms of money. Good. So those are three types of information, accounting information. Your types of information you have to know. We have qualitative information, that is information expressed in numbers. Then we quantitative information expressed in words. Financial information, that is information in regards to money. Good. Now, if we have done that, we have now to know also what? There is something we have to know here. There is something we have to know. What is it now? We have to know now after we have done that, I think we need, after we have get into the users, we have now to know the principle. What are these things that are going to guide us as we are going to venture into this? You know, we have to know the principles, accounting concepts or principles that are going to guide us as we are going to venture into this accounting information. So let me say accounting concepts. Let us now look into accounting concept. And I will start with the definition. What are accounting concepts? Accounting concepts. One, you have to understand that accounting concepts, they are just a broad assumption, basic assumption. You can say accounting concepts are broad, basic assumption. Broad basic assumptions that underline the periodic financial accounts of the business. Broad basic assumptions that underline the business, the business at enterprises or the business transactions that you are going to venture in. Broad basic, the keyword there is the broad basic assumptions. Broad basic assumptions. These are assumptions or the principles or the guidelines, things that are going to guide us, you know. So this one you can say concepts or principles. Good. They are going to guide us as we are going to venture into this. Good. One, we have to know, I will mention them. We have one, we have a going concern concept. Going concern Going concern concept. Going concern concept. Going concern concept will say it implies that a business will continue. As we are now dealing with the business, we tend to understand that business, it implies that business will continue in operation. It will continue in operation, existence, for the foreseeable future or in coming future. Not that this business is going to collapse. No, when we are in the business, we just understand that this business, using the going concern concept, it is going to be there in the future. It's going to be there. That is why we are calling it going concern concept. So you can say going concern concept, it implies that the business will continue in operation, existence in a foreseeable future. Good. So there's no intention for us to collapse this business, or there's no intention for the business maybe not to run. It is going to be there. Good. That is going concern concept. Going concern concept. We have another concept which we have to know. It's called the accrual concept. Accrual concept. Other people call it matching concept. Matching concept. Good. Matching concept, it states that revenue and cost, here it states that revenue and cost must be recognized as they are earned or incurred. As they are earned or incurred. Immediately they are earned or incurred, they must be recognized at that particular time or at that particular period, but not when they are going to be paid. You know? So revenue. In case you are getting revenue at that particular moment, you are going to account for it, but not that moment that is going to be paid. So if you are doing this, you are looking to accounting accrual concept, or when we are in the business as an accountant, adhering to a matching concept, you have to make sure that any revenue or cost that has been incurred in the business, you record it at that particular moment, but not when they are going to be paid. Not when they are going to be paid. Immediately they happen, you do what? You account for them. Then we have prudence. Prudence, another concept. Prudence, as an accountant or in the business, you have to precedence, not prudence. Precedence. So you say the precedence, it says that where alternative procedures, because at the end of the day, we'll have to forego other procedures and go with the others. So you have to say that it states that where alternative procedures or alternative valuations are possible, that the one that have been selected should be the one that gains the most cautious presentation of the business financial position or result. That the one you are going to pick, here, precedence. This concept says that the one you are going to pick, if you decide that this plan has not worked for us, let us now use this plan. The plan you have given us is going to give us the best results. For those who are doing economics, this is where now we say the opportunity cost comes in. You have to forego another one, but the one you are foregoing and the one you are going to pick, it's going to give the best result. It's going to give the best result. Good. Then we have business entity concept. Business entity concept. This is where we will emphasize, because I know most of us, we have business, but we are not adhering to business entity concept. Business entity concept. In business entity concept, one, here we are always reminded to treat business separate from individual or personal needs. Here you'll find someone having a business, let's say a shop, you are selling maybe sugar, you are selling maybe bread. When it comes in the morning, you have to pick a bread without even accounting for it, because it is your business. Now you are treating yourself. At the end of the trading period, you'll not get the true profit or loss. You'll just say that you have got this loss or profit, but you have not you never treated the business separate as a business. Here we are being told, treat this business as business. Whereby if you take something out of the business, record that thing as maybe drawing, and whereby you'll have to account at it at the end of the trading period. Well, so when you'll be doing the act of recording, let's record that thing as what? As drawing, because monetary value has been attached to that drawing. Maybe you have taken out of the business something worth 200 shillings. But if you not account for it, you'll not be able to tell at the end of the trading period. Good. Another concept which we have to know is called money measurement concept. 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 Good. Money measurement concept. This one is says that maybe here is that we are going to account only. We are going to account only. Underline the word only. We are going to account only on things that we cannot, that are of monetary value, or we can attach what money. You know. So things. I give an example. A manager giving a slap to maybe the secretary. The slap, the act of the slap, we cannot record it here. But the moment maybe the slap affected the secretary in a way that she got injured, and the accountant now asks to give the money to cater for the medical, that is now when we do the recording. But just a slap out that it's being sorted by the human resource manager. But an accountant, you will adhere to the money measurement concept, whereby anything that is we are going to attach monetary value is the one we are going to do it to record in the business. Record in the business. We have another one which you have to know is called objectivity. Objectivity concept. Objectivity. Objectivity, or you can say neutrality. Neutrality. Neutrality concept or principles is that as an accountant, you must show objectivity in your work. This means that you must show some consciousness, you know. You must be free from biasness. As we know, statistics, as I always say, statistics like, I don't know, in quotes, but you can say it's a miniskirt because people tend to crunch numbers. It doesn't give you the full picture of something, but you have to believe it. But here, accountants, you are reminded, as an accountant, you must be free from biasness. You must be free from biasness. Whereby, what you're giving us, because remember this information you are giving to the users, they're going to use it in making decision. So you must be free from bias. You must give the good information that is very fair and it gives the true picture of the business. So don't just crunch numbers here. Just give what is, if you have maybe somebody have done drawings of 1,000 Kenyan shilling from the business, record that 1,000. But don't come and record 500. That one you'll not be adhering to the accounting concept. You'll not be adhering to the accounting concepts or principles. And this one, they are used abroad, they are used worldwide. These concepts, they are used worldwide. Even if you go in which country, in accounting, we are all governed with this. Even in the accounting bodies or the accounting bodies that are govern us, they always recognize these principles. So if you go against this, it means you need to be taken another way. Good. We have also duality concept. Duality concept. Duality concept. Remember, we are going to venture in transaction here. After this, we'll be looking into maybe various opening the accounts, balancing, and all that. But we are reminded here we are going to adhere to double entry concept. Double entry concept, because we normally say every transaction has to fold effect in the account. It's either it will you are going to have a debit entry or a credit entry. Then at the end of the day, you are going to do what? You are going to balance our account. So double entry concept has to be adhered here. Then we have timeless. Here, time is also another key factor. Time is also another key factor. We are always reminded as accountants, in the business, you have to provide the information on time. You have to provide the information on time so that the decision can be made also on time. They can be made on time. The decision can be made on time. Good. So you don't have to be late. Good. So I'll mention other ones. We have historical cost convention. historical cost convention, realization concept. So you look into those ones and you will be good to go. So the concept, if you get a question on this, describe, state and explain accounting concepts. There are many. We have a story going concern concept, accrual concept or matching concept, precedence, business entity concept, money measurement concept, objectivity or neutrality, duality, time, historical concept, all that the way we have explained, and you'll be good to go. Nice. Now, as we are preparing this information, as we are adhering to this maybe principles, there are qualities. We don't just come up with information that is just because of information. There are qualities. It has to come with a certain test. Let us look into the qualities of useful financial information. 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 Good. Qualities of useful financial information. 1, understandability. Understandability. Remember, you are preparing this information to the users. So as you are preparing, make sure that the information you are preparing, it must be understandable. They must be able to understand it so that they can make a decision on time. So don't provide things which are complex. Provide the information that they can understand it, they can interpret the information well. So adhere to the understandability. Remember, you are not preparing this information for you. No, you are preparing for other people, the users, so that they can use it to make a relevant decision. So understandability, good. Then we have another one called relevance. Relevance is, for this case, at the end of the day, we have to rely on this information to make decisions. So as now you are providing this information, make sure that the information you have given to us is very complete and is very something that is very tangible that we can use to rely on it. We can use it to make our decision. Then we have comparability. Comparability, which I always love this quality, comparability. The reason why we are having accounting concepts, and I mentioned it is used worldwide, that 1, in accounting, there's no way you're going to come up with your own format. If it is the format of profit and loss account, it's going to be the same. It will just vary with what you are running and betting on what you are varying, but the format is always the same. So here, comparability, you are being reminded that that information you are giving us, let that information, we can compare it even with another firm. That we can able to compare this information of yours with another firm also and be able to make decision. At the same time, under comparability, let this information be compared from one financial period to another period. Not that you have given us this format, this period, account in this financial period. When it comes to another financial period, you have adapted another one. That one will not be adhering to the accounting concept. You will not be adhering to the accounting concept. Good. Then we have another one, reliability. Reliability. So reliability, are we able to rely on this information of yours? Yes. Are we able? Or is full of maybe biasness? So you must present something which is with faithfulness. Faithfulness. Faithfulness must be here. You must be very conscious. Here you must be very conscious because we rely on you. We depend on you. What you are going to give us on boardroom, we depend on you as manager. We are going to use this. So if you give us just matter of giving us the information that you know very well, you have not adhered to the faithfulness in it, you have engaged in other malpractice, you know now that you're not adhering to the qualities of the financial information. In financial information must, you know that it must be, we are going to rely on this information of yours. The user, the stakeholders, the government, all those people, name them, they are going to rely on the information. So reliability is the key factor here. It's important. That's why you'll get in an exam scenario, you'll get a question that says that for accounting information, so you can, a quiz can come from this point 4, where you have been told for accounting information to be reliable, for accounting information to be reliable, then the information should be, then they give you maybe 8 marks. Why are you required to mention that? Here, in short, the information must be presented. One, the information must be presented faithfully. Must be presented faithfully. So talk about faithfully. Talk how the accountant must adhere to this. They must not just give figures or give reports just because of giving. They must be present information that is very carefully. Good. Then they must be neutral, free from bias. Must be neutral. You know, you are free from biasness. Then also to be complete. The information must be complete. Don't give us incomplete information, because the decision won't be matching what we require. The information must be complete. So as an accountant, make sure that there's no omission and all that. So you must be sure of what you are giving us. Then must be presented in accordance with the substance economic reality, and not merely just a legal form. Good. So those are the qualities of accounting information. So you have to know that this is just introduction to financial accounting, which I tend to believe we have learned much. So I will close by giving some of the questions we expect in this unit, in this topic part A of this, because in next topic, next video, I'm coming to start on the recording business transaction. I want to